As is common knowledge, investing is the best way to become wealthy. But even after all of that, not all investments are created equal. And I'm going to show you 7 risky investments in this video that you absolutely must steer clear of. But before that, if you're new to this channel, hit the subscribe button and the notification bell so you don't miss any of our videos. So, without further ado, let's get started. Number 1. Penny stocks. Penny shares are assets that typically trade for less than $5 per share and represent startups with unproven business models. Since most penny stocks are traded over the counter, they are not subject to the same financial reporting regulations as businesses listed on the major U.S. stock exchanges. The Nasdaq and the New York Stock Exchange do not trade all penny stocks, but they do. Penny stocks are volatile and represent businesses with unproven business models, although some investors view them as gross stocks with the potential to produce significant returns. Fraudsters who want to engage in pump and dump schemes frequently target these securities, which can cause substantial losses for investors. New investors are becoming increasingly interested in penny stock trading due to the allure of the quick money that can be made. Number 2. Savings and checking accounts. You are losing money in more ways than you might think due to inflation, as our savings and checking accounts attest to. For every dollar you keep in a savings account, you only make a tiny fraction of a penny each year. The process of rising prices over time is called inflation. You could now defend this financial choice by arguing that at least your savings are secure. Since 2010, the United States inflation rate has fluctuated between approximately 0% and 3.15%. Therefore, the interest rate on your money is only 0.5%. If you're earning $15 per hour but could have made $25, the opportunity cost of that hour is $10. Banks frequently charge fees for opening and maintaining checking or savings accounts. Number 3. Cryptocurrencies. Cryptocurrency is a digital currency with a limited supply and an anonymous digital value. It bears the transaction fees each time a coin enters your possession, which rises in tandem with the rise in popularity of Bitcoin. As a result, they reduce the profitability of Bitcoin and many other cryptocurrencies as they gain in popularity. Despite how valuable and well-known cryptocurrencies have become, the current payment systems do not yet use them. This video is yet more evidence that Bitcoin has been a hot topic for many years. Cryptocurrencies are still not widely accepted though. Variability is another thing to take into account. Cryptocurrencies are extremely volatile investments, much like penny stocks. Prices fluctuate along with the demand on a minute-by-minute basis. While high volatility can result in significant short-term gains, it can also work against you and cause sudden dramatic lows. Additionally, because blockchain and cryptocurrencies are relatively new technologies, it is still unclear how they interact with institutional and governmental rules. Don't get me wrong, the cryptocurrency market is an exciting one, but dealing with today's cryptocurrencies is far too dangerous. Consider investing in tech firms that create microchips and processors to enable cryptocurrency mining and maintenance if you're interested in the market but don't want to take any chances. Number 4. Startups. Likely, you won't be able to participate in the launch of an exciting new startup if you're not the founder, a member of their family, or a close friend of the founder. You probably won't be able to take part as an angel investor either, unless you're a wealthy, accredited investor. By investing in private equity funds that focus on venture capital financing, private individuals can now indirectly invest in startups and participate to some extent in the venture capital phase. Private equity funds invest in a variety of promising startups to spread out a company's risk exposure. According to recent studies, 90% of all invested companies won't last longer than 10 years, and a venture fund portfolio's failure rate ranges from 40% to 50% in a given year. The terrain is quite hazardous because only 1 in 10 venture capital investments will be profitable. Number 5. Foreign currencies. The unpredictability of future exchange rates is one of the risks connected to international trade. Between the time of the transaction and the receipt of payment, the relative values of the two currencies may change. For instance, if a buyer has agreed to pay 500,000 euros and the exchange rate between the euro and the US dollar is 85 cents per dollar, you can anticipate receiving 425,000 US dollars. Payment at the new rate would only be $420,000 if the euro falls, resulting in a loss to you of $5,000. You will experience an unexpected gain in the form of additional profits though. If the value of the foreign currency increases, as you can see, changes in foreign exchange rates can have a significant impact on your cash position, particularly if you use this vehicle to generate investment returns. Number 6. Derivatives. Let's start by defining a derivative. A financial contract called a derivative derives its value from an underlying asset. The buyer commits to buying the asset at a specific price on a specific date. Although they can also be used against the US dollar, stocks, and bonds, derivatives are frequently used for commodities like crude oil, gasoline, and gold. To be clear, the owner of the underlying asset does not necessarily have to be the contract vendor. By giving the buyer enough money to purchase the asset at the going rate, they can fulfill their end of the bargain. Additionally, they might be able to offer the buyer a second derivative contract to make up for the value of the first one. Due to this, trading derivatives is much simpler than trading an asset directly. Recognize now that there are 4 important risks associated with derivatives. The fact that it is practically impossible to determine the actual value of any given derivative makes it the riskiest aspect of investing in derivatives. It is based on the value of one or more underlying assets, which are challenging to value due to their complexity. Mortgage-backed securities have been entirely fueled by the economy because of this. When housing prices fell, no one, not even the developers who built them, knew what the price was, and banks did not want to trade them because they could not even value them. Number 7. REITs. Investors have been drawn to real estate investment funds, or REITs, for many years. An REIT gathers funds from some investors, which are then used to purchase real estate, manage it, and pay all associated expenses. In exchange, the REIT either leases the property to a property management company to manage it or manages it, saving on management fees. Investors in the REIT will receive a portion of the profits once the rent starts coming in. However, there aren't always profits to brag about, and it's important to pay close attention to the risk involved with REITs. Let's examine the risk associated with interest rates. REITs are more in demand when interest rates are low. Low interest rates equate to cheaper real estate acquisition costs. Additionally, since interest rates are lower, other investments like bonds are not producing meaningful returns, which increases demand for REITs. Taxes are the final factor. The standard tax rate is applied to reverse dividends. As a result, your potential profits will be further reduced because your capital gains will be taxed at a higher rate of income tax rather than the capital gains rate. And that's it for this video. Before you go, don't forget to like, comment, subscribe, and click the notification bell for more videos like this. Thanks for watching and see you next time.